If you're operating as an S corporation and not paying yourself payroll, this video is for you. I recently reviewed a client S Corp. I was just typing up this email response back to our client, and this is a profitable business, distributions taken, but zero payroll has been set up for 2 years. So unfortunately, this owner is a little bit behind on their tax filings, and we are getting him caught up on 2024 tax return first to then be able to file 25 and finally be forward looking for 2026, the year that we're in. Unfortunately for them, their accountant, when they first set up that S corporation, just did not follow through with setting up payroll, which reasonable compensation is the basis of the S election, the strategy itself, and then also the requirements for you as an S Corp. So this is actually more common than you think. I come across this all the time. Unfortunately, I wanted to take a few minutes to talk about why that's a problem and what to do about it if you find yourself in this exact same situation where you've been an S Corp but have not started payroll. How do you rectify this going forward? What is the exposure from an IRS perspective, and then how to make it right going forward? So real quick, just give you some facts so you can draw parallels between if this is going to be an issue for you. So this client, they elected S election back in 2023 tax year. So they're now 3 years, going on 3 years on this S election, and they've filed an S Corp. Profits are rolling in, distributions are going out. But based on our review, there is no payroll filed for these 3 years, and also right now in the current year that we're in. There just hasn't been payroll set up at all. It wasn't as though it was set up and then stopped. This cash got tight, which is also a problem. But in this case, nothing was set up to begin with. If you paused payroll, maybe you just hit a downward trend in cash, then that's still a problem, but we'll use this set of facts for this educational piece of content here. Unfortunately, in this case, there is a substantial exposure. So the reason this matters is one of the fundamental requirements of S corporations is that the shareholder is now an employee in the business and must pay themselves reasonable compensation. You can't just skip payroll and take distributions and avoid payroll taxes, which is why when we are making these elections for our clients, we understand this is a 10-year binding election. So we don't just make elections without giving it substantial thought to measure, is this business activity going to continue on? Big reason why you would make an S election. It's a 10-year binding election. Otherwise, it doesn't really do you much good. Has to be continuity in that business activity, meaning you're not going to shut down the business or thinking about selling the business a year from now or 2 years from now. Number two, a very important one is that you're profitable. So if you're not profitable, it's actually not saving you any taxes. It's just costing you money for payroll and compliance and not saving you any money at all. And then the third piece is that we want to make sure both of those tie together. And the third piece is the fact that the business activity actually, it makes sense for you to be an S Corp. So if you're a rental business, it does not make sense for you to be an S corporation. And the reason is that rental income is not subject to self-employed income. It is passive activities. Rental real estate is generally passive, not subject to SE tax to begin with. So it doesn't make any sense to move it into an S Corp, which is designed to avoid the SE tax. If you're a flipper, construction business, HVAC, any sort of trade or business income, then it makes sense to move it into an S Corp. But rentals in of itself does not even make sense to set up the S Corp. The other topic, which I cannot cover on this for the sake of time, is built-in gain, what comes into play when rentals are held inside of an S Corp, which I will cover in a separate video. So back to this, which is if this client of ours, who we took on just this year and have come across this issue, was to be audited, then IRS could take 100% of the distributions. So let's say over the last 3 years, they had 200,000 of distributions. Essentially, IRS can reclass the entirety of that to payroll, and essentially say we can't, there's no determination of how much is reasonable compensation versus distributions. So we're going to reclass the whole thing to payroll, and now it says payroll taxes with penalties and interest, and it gets very, very expensive very fast, and you don't really have a leg to stand on from an audit, from being able to fight that against in terms of coming under audit on this stuff because you didn't actually follow the rules to begin with. See, it's not an easy fix, unfortunately, for a previous period. Can't go back and fix it, but what we are advising for this particular business is that, listen, the best time to do it was 3 years ago. The next best time is to do it now. So let's look at 2026. What does your cash availability look like? Let's go ahead and set up reasonable compensation, start running payroll the way you should have been running it all along. Now maybe we do have a case for when things come up under audit that, taxpayer was completely unaware. Previous account, maybe there was some errors and omissions, did did not live up to their professional expectations, their liability to really advise this client well. It happens all the time. We see it with amateur tax preparers who are not doing tax planning at all. But nonetheless, we want to show compliance going forward and play by the rules so that previous years come up under audit. At least we can mitigate some of the penalties and interest by making a case where the taxpayer is trying to be compliant going forward. So the goal here is to show compliance, demonstrate the intent, and reduce the audit risk. So the big takeaway for us is that an S Corp is not just a tax election. It is a compliance structure. If you want the tax benefits, you have to follow the rules, and the payroll is not optional. So if you want to make sure that your S Corp is set up properly, here's 3 things that you should review. Number 1, are you running payroll? Are you on payroll? Number 2, are your payroll taxes being filed quarterly? And then number 3, are you issuing yourself a W-2? If not, you can fix it now instead of waiting till year end or after year end when it becomes either too expensive to fix or not practical to fix later on. So hopefully this was helpful. If you have questions, specific questions on this, my link will be in my information is in the link below for you to reach out to myself and my team and we can help. Thanks.